All right, we're going to get started here. Hi, everybody. Thank you for joining us today. We're going to talk a little bit about last year and its recovery and what to look forward to in 2024. First of all, I'm really grateful that you guys are joining us. I am Kelly Olczak. I am the managing partner of Lindley & Company. We are a registered investment advisor, a fiduciary, and we manage the finances for a handful of families in the area. We are also 100% woman-owned, which is really neat. I really appreciate that. With me today is the one and only Chaz Miller. She is our operations manager. She is the wizard behind our operations, and along with her is Becky Gillette, who is our dedicated chief compliance officer. Becky and I formed the firm, joined our practices in 2018. We manage about $115 million and are very happy to say that we only work with a handful of families. One of the things that we're going to focus on today is educating and empowering our clients and our friends so that we help you get and become a better investor, become more savvy. Chaz is going to be the one steering our chat today. She'll be keeping an eye on any questions that come up. I really like lots of questions throughout this whole presentation if you have them. So feel free to add your questions to the chat function of the Zoom, which I think you can find on the bottom of your screen. And at the end of our discussion today, we're going to share with you some useful handouts. One of them is for those of you who might be around 55 or older and thinking about retirement. And we call that the 2024 Retirement Calendar Checklist, as well as our key financial data for 2024. I think you'll find both of these pieces really helpful. And then to get us started, we're going to, at the end, I should say, we're going to ask you help us with a short survey because we want to know if the content we're sharing with you is hitting the mark. Chaz is going to launch our first set of polls. This is the only set of polls. They're very, very short, but they're going to help us understand who we're speaking with today. So Chaz, if you can launch those and we will get an idea of how people are thinking. Thank you.
Yeah, I just sent out the first one. So there's 3 short polls. We're just going to do one after the other, but I'll leave each one open for a couple of minutes.
How are we doing on that one?
We're doing good. I think once I hit the minute mark, I will end.
Great.
And share.
Yeah, I expected cautiously optimistic. Okay. Okay, why don't you push out the next one? Thank you.
Same thing here. I'll give that one about a minute.
And I want to thank you guys for participating. We had 11 out of 12 people answer these questions. It's very helpful. It helps me direct and understand the kinds of things that might be pertinent to you throughout this conversation.
That one's got about 10 seconds left.
Thank you. Great. Perfect.
Great.
Thank you.
And here's our last one. Got about 15 seconds there.
Thanks, Chaz.
I'm going to end that one, but if anyone got cut off and wanted to answer, feel free to send it in the chat.
Great. Thanks. Awesome. These are great. Let me snag these so that I can keep them in front of my nose. Awesome. Okay, these are really great and very pertinent. Thank you very much. So let's get started. How do I get back there now? There we go. Okay, so we're going to cover, this is just a quick roadmap of what we're going to cover. So we're going to talk about the year in review, how the market fared last year. 5 key questions for early 2024. 4 main themes we believe are quite important. 6 important investing principles and 8 key strategies in a bumpy market. And it's important to remember that markets are bumpy when they go up and when they go down. So let's talk about the year in review. So let's break it down in friendly terms. I'm really careful about using jargon because I was just like you guys 19 years ago. I didn't know very much about investing, and I really get put off when super smart people use words I don't know. So we're going to keep these in bite-sized chunks. So at the beginning of 2023, the market started off looking up after, 2022, which the bar was pretty low in 2022. Investments across the board perked up, doing even better than most people expected. As we move forward to 2024, I think we've got a little bit of a spring in our step. I know we're feeling good about where the world's wallet is heading. You might ask why. Well, I think we can all remember how prices shot up with inflation. And a lot of that stemmed from COVID and being locked down and changes with supply chain. And, when you stop supply chain, meaning you're buying parts from overseas to build equipment in the US, and you can't ship them in, then things are going to slow down. And so we really are dealing with inflation that was affected by those events, and also supply chain issues, as I mentioned. And so we have experienced some pretty incredible interest rate increases. And obviously we know how much the groceries and gas are costing us at the pump. But I think we've seen the interest rates increasing stopped, and they're in an ease position right now where they're not doing anything. The Fed's kind of looking around to make sure that the data they've got right now is consistent. So they have eased off on what they call money tightening tactics. What does that mean? it means they've stopped raising interest rates. And what's the cherry on the top? We're pretty sure that 2024 is going to be a comeback year, even with a political market, political environment on this year's calendar. And so having a balanced portfolio is back in style. We'll talk a little bit later, but we think that the Fed will start to cut interest rates even this year. Okay, so when you watch the news at night, you're going to look at, you're probably going to hear about the Dow Jones Industrial and the S&P and probably the NASDAQ. These are 3 indexes that we use as a country to give us an idea how the market's going. So the Dow Jones Industrial is just that, 30 companies in the industrial sector, whereas the S&P 500 has all different types of sectors: telecommunication, telecom, consumer, discretionary, real estate. And so it's called the broader market. And then the NASDAQ tends to be more growth companies, tech companies. So you'll see here in this slide that the NASDAQ was up 44%, the S&P was up 26%, and the Dow was up 13.7%. So the market did come back pretty strong after September. However, the S&P 500, even though it is 500 companies, there are 7 companies within that index that really do skew the return. So Apple, Microsoft, Alphabet, Amazon, now NVIDIA, Tesla, Meta, which is Facebook, they've gained between 48% and 238%. NVIDIA is, see, that would be this guy. NVIDIA directly is up so high, it's actually a $1 trillion valuation for the first time ever. And that's because of AI demand for semiconductor chips. So this slide, all this is saying to you is, out of 500 companies, these 7 represent about 30% of the market value. And if you took them out, you would see about a return of 12%. So be careful when you're looking at the S&P 500 because it is skewed by these larger companies. And while I am leading this discussion, I really encourage you guys, if there's a question on a slide that you want to ask, please let me know and I'll slow down and we'll talk about things. So I love this slide. I've been using this slide forever. The question to this slide, I get this all the time. Kelly, what do you think the market's going to do this year? I have no idea. And nobody on TV knows either. In fact, if any of you remember who Alan Greenspan was, he was the Fed chair for a long, long time. He was only right once. So I like this slide because when I've got clients that are worried about, oh my gosh, I wanted to retire this year, the market's terrible. I like to use this slide because it kind of shows you that every single year, this goes back to 1980, every single year for 45 years, we've had good markets and bad markets. Of those 44 years, only 10 of them ended negatively. But you'll see in the slide, for instance, let's look at, some of these are a little hard to see, but in, I figured out this math. So look at 2020, and that's about right here, okay? So that, during that year, COVID year, the market was down as much as 34%, and it ended up 16%. So these little gray bars tell you where the year ended. The red numbers are during the year, how much did that market pull back? So it does validate. One of my favorite things that I like to say to people is, you're always going to have good markets, bad markets forever. You just have to figure out how to deal with them. So hopefully some of these slides will help you with that. Okay, so this one is a really neat one as well. a lot of people don't think bonds are exciting, which I don't think they are, but over the past 48 years, the bond market has only had 4 bad years. That being said, a lot of people think bonds are, quote, safe. There's nothing safe. Bonds do not keep pace with inflation. So, if you've got a bond that is, like, for instance, paying 6% and inflation's 9.5%, you're still losing money. I want you to realize, though, that bonds are an important part of any bond or any diversified portfolio. They barely eked out positive returns last year, barely. And over the past 15 years, the annual return of a diversified portfolio, that means a blend of stocks, bonds, cash, other types of investments like alternatives, they have returned about 6.1%. Okay. So core personal consumption expenditures. This is what's called PCE, okay? And the Fed uses this measure for personal consumption inflation rates. They do exclude food and energy because those things are very volatile. And I think we all remember how expensive eggs were and how expensive gas is. Last month, however, so what the Fed's trying to do is they're trying to get our inflation rate down to 2%. That's their goal, okay? And last month, prices fell for the first time since 2020, which gives the Fed a positive sign, showing that inflation is showing and that what they're doing to the short-term interest rates are taking effect. Looking forward, we think the Fed predicts an inflation rate of about 2.2% in 2005, and then they will hopefully reach their target of 2% in 2006. This updated forecast is slightly more optimistic than the previous one from September, but we're always getting new data. Any questions? Unemployment rate. So this is mind-boggling. So the unemployment rate in November decreased to 3.7%. And then in October, it was down, in October, it was 3.9%. So in November, it was 3.7%. And we just got rates for January still sticking around 3.7. But what's not in this slide, because it was new data this week, is that the January jobs number, we added $353,000 jobs when the general consensus was 185,000. That's really, really good news. Okay, so let's chat about the US economy. It's kind of like a hidden track star that's sprinting past expectations. So picture this, even though things look higher interest rate wise and rising prices are trying to hold it back, there's a bunch of other stuff going on both here and around the globe that are making the economy do what it's doing in a positive manner. So so if you look at all those things that we make, that's called gross domestic product. That's what we make. That's all of our goods and services, manufacturing. The package grew at a steady 4.9% from July to September. That's faster than the already zippy 2.1 we saw at the end of 2023. So economists thought it was going to be about 4.7%. And it's very important to realize that these numbers are adjusted for inflation. So on that chart, you're going to see a little box in the middle, and where it says Q3 2023, quarter over quarter is 4.9, and the year over year is 2.9. That's very healthy. Okay, so there's a lot of data on this slide, but really what it is it kind of explaining what the Fed has done since the beginning of 2022. It's raised interest rates, and we haven't seen interest rates this high for a long time. these are short-term rates, okay? Short-term rates that drive, mortgages and those sorts of things, money market. So the Fed has hiked, 5.25% since that period of time. And you'll see in this slide, Chaz, if I move my arrow, can you see my arrow moving? I've never asked that question.
Yeah.
Okay. So you'll see that there's some consensus here of how interest rates the Fed is going to cut them. And these are projections out to 2025. So this is a very big one that I'm hearing a lot because there is a lot of political stuff going on, as we know, and it tends to worry people. How are the elections going to affect their portfolios? Across the entire ballot, there's not enough historical evidence to support investors voting with their portfolios rather than their personal and political beliefs. So what that means is don't make changes in your portfolio because you're worried about how the market is going to behave if one person gets elected or another. Okay. How the policies implemented by elected officials are important, especially with the new administration responsible for addressing the expired tax credits. So it's called the Tax Cut and Jobs Act. That's the one that maybe you guys remember that you had a different way of selecting your deductions for your taxes, and you couldn't deduct like your more than $10,000 of interest and property taxes. So that might come back in 2026. I'm not going to dive into that one because that's a longer story, but those are the things that can be affected by whoever is elected this fall, fall. Okay, so historically, what do presidential elections look like? So obviously, every market is bumpy every year. What we see that in an election year, the first half of the year is more careful, meaning it's not going to rally up or down, but you'll see in this chart, it really does start to make big differences like in July. And again, this is historical data, but it's sort of a nice reminder that markets they can be emotional, but they tend to be a little flat during election years at the beginning. Okay. Any questions so far?
None so far.
Okay. So I ask myself this question all the time. How are we not in a recession year yet? Okay. Because, and we'll get to a slide about GDP, but consumer spending is about 2/3 of our GDP. And if you take a look at this slide, right before, let's see, can I get there? This area here, right underneath the 8.6. This is around the right before the financial crisis, 07 to 09. And if you may remember that people just believed that their real estate values were just going to keep going up and grow up and never go down. So folks were spending way more and saving a lot less. And then what happened? We just had a humongous oops, and bonds and stocks were affected very badly. And it made people realize they needed to start spending or saving more. So then you'll see that after 07 to 09, people got the message, really did put money away. And during the first year of the pandemic, savings skyrocketed, like no duh. Why? You couldn't go anywhere. And because all of our activities were shut down, we really saw a large fiscal transfer, which filled consumer wallet. And that was where the Trump administration gave money to the people so that they could survive, which I thought was brilliant. However, as business returned, and we see that here later now, we're seeing that people are spending more. And that's what's helping drive our current market conditions on the why we're not in a recession yet. Okay. I know I don't have to tell you guys how expensive things have been, but this slide is really interesting to me for two things. The cost of housing, especially rent, has gone up considerably because, and I know Kat Cowie's on the phone on the session with us today, and she's a realtor. Inventory, there aren't a lot of houses, and so people are renting. And so you'll see here where it says shelter, this dark blue, it's really gone up because of inventory, and so rent costs have gone up. The other one that I was very surprised, car insurance, also super crazy. Why? So again, going back to COVID, all manufacturing was pretty much stopped. You couldn't buy a new car. If you could find inventory, you got it, but it was more expensive than you bought, than you would have before the COVID situation. And so what did people do? They bought used cars. And so car insurance is a very large part of this as well, because older cars need more fixing. And if they need more fixing, insurance prices are going to go up. Anyhow, so I just thought that was pretty propeller heady of me. Sorry. The Fed is responsible for restoring price stability. And that's why they started increase rates and to hopefully slow down the economy and steady the pace so that it's more consistent, which leads to stability over long term. So like other central banks around the world, the Fed defines interest rate, their target at 2%, which is what we're trying to shoot for. Okay. I know that a lot of people have seen CD rates that are crazy, and it's been years since I've seen a CD rate over 5.25. And people do like them, who wouldn't? But they are not they're not an entire part of your portfolio. They are part of it. And there's different risks in CDs. It's called interest rate risk. And, I had a client who was super worried about the market at the beginning of 2023 and did purchase a CD, 5.25. Meanwhile, the rest of their portfolio way outperformed that CD. And that person did not need any short-term money. They were just worried. So this chart shows the 6-month certificate of CD rates during the previous rate hike cycles and the subsequent 12-month total returns of CDs. The Bloomberg US Aggregate Index, that is an index that measures bonds, okay? The S&P 500 and a 60% stock, 40% bond portfolio. As a result of Fed's tightening, which has been pretty aggressive, CDs have risen considerably and look very attractive. But if you look at the returns of the other investments, CDs have not been a great way to deploy additional cash. Here's another one of my favorites. Why is my portfolio not up 45% when the NASDAQ is? Well, because you don't own the NASDAQ. And if you did, you should fire me because you should have other things. You need a mix of US stock, non-US stock, US bonds, non-US bonds. You need different kinds of, especially now, investments that are not touchy when it comes to rising interest rates. So again, we talk about these 10 companies that really outperformed everything else. So in the S&P 500, I used wrong data. I said 13%, but in the S&P, those 10 stocks grew 86% versus everything else would, which, returned 14. I'd take 14 any day. Those 10 stocks are really scary. They're really bumpy and really touchy. But those 10 stocks did dominate so much that people think that their return should be that way. And I would say no. I would rather take moderate risk and get a nice, consistent return than big peaks and big valleys. So we're going to move on to the 4 themes for this year. And for those of you that are clients, we are about to rebalance our portfolios for Q1, and we tend to rebalance our IRA and Roth accounts, 4 to 6 times a year, depending on what the markets are doing. Whereas if you have a non-IRA or non-Roth, we are a little gentler with that because we don't want you to have short-term capital gains if we can avoid it. So at the high level, here are some of the changes you're going to see coming up next week. So we are, on the stock side, we're really optimistic about the stock market, and we have a firm bias toward the US. We are overweight on our portfolios 2%. And because we think that for the short term, we're going to have a little bit of a market breather in Q1. We're not going to make any big changes to the exposure of our technologies positions, but we are unwinding some of our broader growth-oriented positions. Growth-oriented positions are companies that grow fast, but may not pay a dividend, and they tend to be bumpier. So we are going to start to unwind that, not completely out, but we're leaning more towards value companies. Now, what's a value company? We do believe these companies are going to shine moving forward this year. A value company is an unappreciated company with strong fundamentals that pay a dividend. What is unappreciated? They're boring. They're not sexy like Apple or Nvidia. But we are a contrarian group. We do believe in high quality investments that you hold for a long time. When we do lean from, toward a growth sector a little bit more than the other, it's because we're trying to take advantage of that market cycle. But we do love things that pay dividends. On the bond side, we are reducing our interest rate sensitive long maturity bonds. What's a long maturity? Anything over 10 or 15 years. So we are paring that back, and we're going to put some hay in the barn and take some profit off of those bonds and reinvest those in investments that are not interest rate sensitive and shorter maturities. All right, so let's talk about the 4 themes for this year. Macroeconomics. So our portfolios, we have worked incredibly hard to reduce interest rate risk in our bond portion of our portfolios. We have really accomplished this by diversifying fixed income. One of the investments that we like is a private debt position that has behaved very well, and because it's not sensitive to interest rate, you don't see big peaks and valleys. Then there are other kinds of investments that are not interest rate sensitive, like treasuries, that if interest rates go up, so does their interest rate. Those are called TIPS. So the private debt tends to have a higher yield than your traditional fixed incomes, and they tend to be a lot less volatile. Geopolitical. Yeah, so there's a lot going on against our election cycle. And I think we'll see a lot more of that, even though it's not in our backyard, it really is. So we are being very careful because rising geopolitical risk can trigger trade restrictions across the globe, where you can't buy or sell something in a country anymore because maybe that country is restricted. So we are really looking at companies that are going to benefit from reshoring of their critical supply chains and bringing them back into the US, which will increase our investments, especially with the national security focus. I mentioned this earlier. 2023 was the year of AI. Artificial intelligence has propelled tech companies, especially those specializing like NVIDIA, in AI. And that's really driven that portion of the stock market and leading to potentially enhanced investment returns. We are being very careful about that, though. We're not getting greedy. So we do have a really great research team that helps us figure out where we should put new money and where we should take old money. Like last quarter, we moved away from any companies that had any exposure to China because their economy is doing very badly. And I think it's going to do very badly for quite a while. So this is another big slide that talks about the different kinds of companies that invest money in the market. And we are the private wealth managers here. Okay, so we are, like I mentioned, we are adapting our portfolios to handle ongoing high interest rates and any curveballs that could be thrown in by those geopolitical events. So we are adding active management into our portfolios, and we're positioning ourselves to smoothly, hopefully, navigate through the market fluctuations as businesses adjust to these still new normal high rates. Okay, so jargon alert. I actually on my slide wrote, okay, jargon alert. What does active management mean? So there are two kinds of diversified buckets of investments you could buy. One is a mutual fund and one is an ETF. It used to be that mutual funds were always active, meaning they are buying and selling stock all the time. But now ETFs also can be actively managed. So when we add active management, we're actually hiring money managers to look at the areas of the market that have unusual risk and help us navigate those. We are not stock pickers. We can either focus on picking a stock or focus on our families. And so we really rely on groups from JP Morgan, Goldman Sachs, BlackRock to help us navigate these. So that when I say active management, I hope that explained. Keep going, but I won't. Okay, so rules of thumb. It pays to own stocks. We talked a little bit about CDs and fixed income. Those two investments do not keep pace with inflation. It's important to remember pullbacks and even corrections are to be expected. We always keep our long-term view on for your long-term goals. Some of our clients have short-term goals, like they want to save for a car in 3 years. We're talking, when we talk long-term goals, we're talking your long-term retirement goals. Non-recession bear markets are typically shallower and rarer. Market timers miss out, and don't let your feelings about the economy torpedo your investment strategy. So here we go. This slide is another one of my favorites because it really does show how, especially after a bad market. So this one here is COVID, and look at that rally. So when it comes to funding investment objectives, there is no alternative for better potential returns than equities. I just think that large growth, just that zing up from 2020 to 2022 is amazing. Stay in the market. Very simply, stocks have traditionally always done better. Not negative, more positive than negative. Here's my favorite slide again. So really going back to the previous slide, even the best returning years for the market have at least one intra-year decline with an average intra-year decline of 14.2%. So basically this chart just shows that even when you have a good market, during the year, you might have a bad market. So in 2020, as an example, the market pulled back 34% and it ended up 16. 2009, this is right after the as the financial crisis was coming to an end. 2009 was down 28% during the year and ended up 23. Stocks spend more time in a bull market than a bear. So bull markets are good, bears are not. And I meant to mention earlier, this webinar is being recorded. So if you want to come back and listen to me again and look at these slides, you'll have a way to do that. So when we've been asked by our clients to help them with their investments, we always start with a financial plan. Because if I don't know what the money is supposed to do, how on earth can I tell you what to do with it? I can't possibly give you good advice. And time horizon, that's what this slide is talking about. Time horizon is everything. So like if you had a 20-year-old child and you were 65 and you both answered a risk tolerance questionnaire and answered them exactly the same way, your 20-year-old child's portfolio will be riskier than yours because it's assumed that they don't need that money very soon, whereas you probably do. And so in this chart, you'll see over a 5-year rolling period, a 60% stock, 40% bond portfolio could return anywhere from 1% to 21% the first year, right? But if you go out farther, the probability of a bad market goes away. And this does assume that we are rebalancing and keeping your portfolio diversified. So if you've worked with me before, you've heard that I say buy low and sell high. It's probably something you've heard somewhere else. The other one I have is if it hurts, you should be doing it. And the reason I say that is if you've got an investment that has done really, really, really well, you need to take some losses. Sorry, some gains, because that's not going to keep going up. So in this slide, what you're going to see is that yeah, of course, the equity market could decline further in recession, but that risk should be weighed against what has already been priced into the market. High risk of recession alone is not a sufficient reason to reduce your stock position, especially if it's paying dividends. When we have equities that have already suffered a significant drawdown, that's the perfect time to buy. Now, mind you, if I had a bunch of girlfriends and the shoes, we went out to get a new pair of shoes and they were at 70% off, we'd buy those shoes. But to get an investor to buy when the market's down 70, which God forbid, it's a little harder. So I hope these slides are helping you understand the importance of understanding the long-term way to invest. The biggest rule of thumb that I could ever share with you, and I sound like a broken record, stay in the market. That doesn't mean get out to cash, or it doesn't mean you shouldn't reduce some of your stocks to bonds. But what it does mean is make sure you stay on target with your long-term goals. So this chart shows a stock market return if you miss the best days of the market each year. Okay, what's a best day? It's a bad day when the market pulls back. Now we know that investors don't jump consistently in and out the market, especially our clients. We don't jump in and out. But even if they did, they would not be at risk of only missing 1 or 2 days, but it's very hard to get back in the market. Time in the market, it's time in the market, not timing the market that matters. Here's an example of that. Shazam. From a visual perspective, just missing 60 days, 60 best days, that really you're down 4.85%. Any questions? If it hurts, you should be doing it. Well, consumer sentiment has recovered slightly since 2022. Inflation is still on everybody's mind. Okay, so on average, investing during a confidence peak returned 3.5%. Okay, it's easy to get in the market when the market's doing well. It's basically what I'm saying. But if you were to buy when the market's low, which we call the sentiment trough, that has historically returned 24% over a 12-month period. consumer sentiment does not always match up where the market is and where it's going. By the time you figure it out, you're probably too late. So that's why you stay in the market. Okay. So what about when the markets are really bumpy? Here are 8 principles that I think are time tested. Always invest in your retirement accounts if you can, systematically. If you can do it monthly, do it. I am talking a lot with our clients about considering Roth conversions during a market pullback. I always want to make sure that we're not cash poor. So I like to see 3 to 6 months in money. But if you have more than that, it's a perfect time to put a little bit more money in the market. If you are thinking of retiring, perhaps consider delaying your retirement a little bit. Now, this bullet depends on your financial plan. For those of you who work with us, I really want to stress test the potential for retiring all of a sudden. Okay. So, and some people don't want to wait. And if you've been good savers, which the majority of our clients are fabulous savers, I actually have to tell them they can spend some money. Retirement timing might not be a problem, but it's still important to realize that you could retire and the market go straight down the next day. So we like to have a plan B. Okay. So we do this for our clients, but some of you may be doing this for yourself. Rebalancing is so, so important, even when the market is doing fantastic, and especially when they're doing bad. Because you might have something that's overvalued, and like, I don't know if you guys remember GameStop, but there was absolutely no reason why that investment went up, except for there were outside investors that were artificially pushing the stock up. And getting out of that Bitcoin, that's another one. People, oh, I don't want to sell that. It's worth $65,000 today. Well, tomorrow it was worth 20. So it's really important to have a goal with the investments that you have and to keep them within the boundaries that you set up. So if you have a 60-40 portfolio, you don't want to be a 70-30. That's too much risk. So you want to keep it within your guardrails. So a lot of people are going after these strong performers in the tech market. You may have missed the market, so you've got to be very careful about that. And when you see this, consider getting more aggressive with your asset allocation. That doesn't mean Bitcoin. That means if you're a 50% stock, 50% bond portfolio, and you need to be a little bit more aggressive, a 60-40 might be a good fit for you. Nope. That is it for today. And I am 10 minutes early. So, questions for you guys. From you guys. Crickets. So you guys are going to get an email with a survey, which is very, very short. We just want to know if we're hitting the mark, if there's anything, if you want to find the chat, thank you, Chaz. If you want to ask questions, there's a little chat box at the bottom of your screen. You can ask questions there. Thanks, Kat. I really appreciate your time, all of you. I'm really glad to see you guys again. Feel free if you've got questions, even if you're not a client and you want to know a little bit more about what we covered. I'd be real happy to talk. And also, we're not salesy, we're not pushy. We just try and run these things so that we can help you guys become better investors. Thanks, Mike. Great to see you. Chris, thank you too. And I think that is the end of that.
Thanks, everyone.
Thanks, everybody. Have a great day.